Hi, Chris Camburn, 1406 Financial, where our tagline is investing at your pace. Here to provide some information to you on interest rates and whether you should invest now or not. Today is February 1st, 2022, and as many of you may be aware, there's a lot of concerns out there about inflation, and so the Federal Reserve is considering to raise interest rates. It's been in the news and in the press, and just to substantiate the point, this is from the Wall Street Journal. Stocks turn lower after Fed announcement on interest rates, and that's an article from January 26th. That's when the Fed made the interest rate announcement. So Fed interest rate decision tees up March increase. Fed minutes point to possible rate increase in March. And then here's the statement from the FOMC, Federal Open Market Rate Committee. And so January 26th, 2022, just about a week ago, Federal Reserve issues FOMC statement. And if you scroll down, you can read all their notes. But what it says here, let's see, with inflation well above 2% and a strong labor market, the committee expects it will soon be appropriate to raise the target range for the federal funds rate. That's code for raising interest rates. And so that's why the bond market's been going crazy. The stock market sold off initially and is starting to recover as we're recording this. And so so if you are an investor and you're saying, well, if I have current bonds and if interest rates rise and my bonds are going to go down, why don't I sell them and just buy back at higher rates? Or if you have cash to invest, you might be considering, why not wait until rates go up to invest my cash? Well, I'm here to give you just some math behind it, whether you may want to or may not. That's going to be your decision. But I just want to show you there's a risk to investing. There's a risk to investing now, and there's a risk to waiting. And if we look at where the current 10-yield rates are, this is bonds and rates from the Wall Street Journal. And if you scroll down a little bit, the U.S. 10-year rate is currently at 1.7813%. So that means that if you invest today for 10 years into a U.S. Treasury, you'd earn 1.7813% for the next 10 years. Now, whether that's a good rate or bad rate, I'm not here to say. I mean, certainly lower than we've experienced in history, but it's higher than a year ago. If you see, the light blue is current rates, and the black line is a year ago. A year ago, the 10-year was at 1.0783. So it's better than a year ago, but I know it's been higher in history. So all I'm going to do here is put these rates into an Excel spreadsheet and figure out if we invest now for 10 years or if we wait. How much money do we need if we wait to equal how much money we'd have if we invested today? So let me explain what I've done here, moving over to a spreadsheet. So today is February 1st, 2022, and the rate, as we just saw in the Wall Street Journal, is 1.7813. And this spreadsheet, all it does is it does math, right? Put in some formulas to say if I invest $100,000 today at a rate of 1.7813, how much would I have in 1 year? And you can see $101,781.30. You say, okay, well then my investment goes again, and I earn 1.7813 because it's a 10-year investment. And you keep doing the math. You'll see in red, I've noted this is compound interest. That means that you're reinvesting all the interest along the way, and you're not putting the interest to the side. And so simply just doing a spreadsheet math, we can see that if we invest $100,000 today at 1.7813% and compound the interest, at the end of 10 years, we'd have $119,000, $310.85. Then what I've done is I've created a column that says future rate. And what that means is that if you wait in 1 year increments, if you're going to have $119,000 after 10 years, what rate do you, if you wait a year, what rate do you need for 9 years to equal the amount of money you would have had you started today with 10 years of time? And so if we wait 1 year to invest $100,000 and we want to try and match the same 119 we'd have if we invested today, the future rate, you need 1.98% for 9 years to equal 1.7813 for 10 years. Now, will rates be 1.98 for 9 years in 1 year? I don't know. This is called interest rate risk. And so if you have $100,000 to invest and you don't like 1.7813, well, you can wait a year. And as long as rates are higher than 1.98, let's even get that out to 2 decimal points. Let's be really, let's be a little bit more precise with it. You need 1.9812. Well, let's say 2 years go by. Well, you don't get around to investing that $100,000 in a year, and you wait because you think rates are going to rise again. Well, in order to have $119,000 after what would have been a 10-year period, so February 1st, 2031, that's 10 years from today, if you wait 2 years to invest that same $100,000 and you've earned no interest in the meantime, you need 2.23% for 8 years to equal 1.78 for 10. So this is it's the risk of waiting. I mean, you're sort of darned if you do, darned if you don't, right? I mean, this is why we try to take just systematically invest and take interest rate forecasts out of the equation. And what you can see here in the last column, I check my math. So essentially, if these percentages are correct, the math here, it's $100,000 for 10 years. $100,000 at 3.5943% for 5 years equals 119,385. And as long as these two numbers are equal, my mathematical formulas are right. Now, keep in mind that I brought to your attention earlier that this was using compound interest, which means you continuously reinvest your interest back into a 1.78% rate. Well, let's say you're taking interest and you're living off of it or putting it in your pocket or just not reinvesting it. Then it would be a simple interest equation. And I wanted to see, would simple interest make a difference if this was a simple interest equation? So what we have here is simple interest being paid to you and not reinvested. $100,000 earns $1,781 a year. And after a year, you have 101,781. Your investment in year 2 is worth 101,781, but your simple interest only pays you based upon your base amount, and you have 103,562. So with simple interest at the end of 10 years, you have 117,813. That's a little bit less than the 119 with compound interest. So what it just means is that the future rates don't have to be as high. I mean, still higher, but not as high. 1.98, 2.23. And look, if you wait 5 years, you need 356 for 5 years. Simple interest to equal 1.78 for 10. I mean, interest rates have to double. So, this is what happens when you try and guess interest rates. And if you think rates are going to rise, you're welcome to wait. But my response to you would be, listen, if you want to win, if you want to have, will you have been successful by waiting? I guess is how I should ask this. I mean, if you look at the end of 10 years from today versus waiting, at the end of 10 years from today, do you have more money by investing now or waiting to invest? And I'm making no interest rate forecasts. I certainly can't guess these things, but I just want to put to you the math behind waiting to allow you to decide if you want to invest today or if you want to wait for rates to rise and try and take advantage of rising rates. You're certainly welcome to. But I just wanted to put some math out there so that you know what hurdles you need to eclipse to equal what you could achieve now. So I hope this is helpful. This doesn't have to be complicated, or I try to take a lot of the complexity away from guesswork and projections and all that stuff. So this doesn't have to be difficult, but hopefully this will make your decision a little bit easier.